don't just chase safety blindly, because in your chase for safety, you will compromise on the return on investment, which will not be able to protect the worth of your capital.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, the government has increased the interest rates on small savings schemes, while the debt funds have lost their favorable tax treatment. But how much of a difference will it make to your life? Where, out of the two fixed income avenues, where should you invest? We'll talk about it in today's episode. Keep watching.
It's a sheer coincidence. Two things happened together. One was that, the union budget was passed, and what came as a surprise, what was not part of the pre-stated budget provision, was that the indexation benefit available to fixed income funds, the debt funds, that was withdrawn. The tax provision was, if you would have invested in a debt fund, held it for 3 years, the gains from those investments will be available for indexation, and available for indexation and taxation at 20% only. That made it very attractive compared to any other bond or fixed deposit. This was a huge advantage for fixed income funds. It was the underlying nature of the investment was the same, but the tax treatment was very convenient, or was very liberal. This withdrawal came as a surprise, and that was the hue and cry. The second was that in the budget itself, it was provided that senior citizen savings scheme, where the maximum permissible investment was 15 lakh rupee, was increased to 30 lakh rupee. And the small savings rate went up. The small savings rate getting changed is a very routine matter. It should happen every quarter. Many a times it does not happen because it does not require any change. And there is a basis to it, there is a formula to it. But the big difference was that when interest rates were going down, small savings rate did not come down. But now when they are beginning to go up beyond a certain scale, small savings rate have been able to catch up with the rising rates, and today they have become one of the most attractive savings instrument in the fixed income arena. So if you have to invest for fixed income, these are the instruments with highest safety. So this couple of things combined together, which is a plus, which is a minus, and one is just enabling provision. All these things combined together was actually a very happening time for fixed income. The rise in interest rates of small savings is the good news. The biggest beneficiary is the National Savings Certificate, where the rates have gone up by nearly 70 basis point. 70 basis point, it makes it very attractive. And in case of senior citizen savings scheme, it has gone up by 20 basis point, but it was already the highest. In senior citizen savings scheme was already yielding 8%, which was the highest, and now it has gone even higher to 8.2%. So that's the good news. Small savings yielding higher return, so you earn more. On an investment of 10 lakh rupee, that translates into something like 7,000 rupees from a National Savings Certificate, and 2,000 more from senior citizens savings scheme. The bad news is about the absence or the abolition of the indexation benefit which was available to debt fund. The difference will be about 15% if you are investing whatever amount, and assuming those instruments or the funds actually gives you exactly the same returns. Post indexation, for somebody in the highest tax bracket, he will earn 15% less. But you have to see that are you in the highest tax bracket, and you also have to see one more benefit that you are deriving, that now the new tax regime has made it even more liberal to the extent that there's a great likelihood that up to 7-8 lakh rupees, 9 lakh rupees, it will be just 10%. So the maximum difference will be 15%, and depending on your tax bracket, it can be even lower. But this is something which is, you may be disappointed, but we can't do anything about it. For senior citizens, it is pretty straightforward. You will earn little more on senior citizen savings scheme, and you can you can invest more and also earn more. That apart, I think every person, depending on his investments for regular income, must avail as much as possible to the extent of, the 30 lakh rupee entitlement every individual has. That should be availed as much as possible. Beyond that, I think you need a financial plan. You need to invest in equity, you need to invest in fixed income. Don't invest in fixed income beyond a point which will deliver you the returns, deliver you the income, but you don't need it. Don't just chase safety blindly, because in your chase for safety, you will compromise on the return on investment, which will not be able to protect the worth of your capital. Every investor needs fixed income except for their very early stage of their SIPs. They don't have anything you don't have anything to protect or guard yourself against while you're accumulating your savings. So first 1 or 2, 3 years when you are just building it up. But after that, once that money becomes meaningful, then every investor should have fixed income. Now it depends how much fixed income. Should it be 60%? Should it be 75%? Should it be 30% or 25%? That entirely depends on how upset you get with the decline or the extreme movements of equity. You should look at all your fixed income investments together, which means public provident fund. That should be your first stop for any young person. You should look at your portfolio holistically and make sure all the fixed income does not exceed beyond 25%. And of that 25%, have 5 to 10% into fixed income, the short-term debt funds. The reason is that for anybody who is accumulating and he needs fixed income, he needs to have fixed income for primarily one reason, that you need to rebalance. Equity markets go crazy, and whenever they go crazy, equity goes up in value or goes down in value dramatically. When it goes down in value dramatically, you should have money to invest, and you should have money to invest. That money should be in fixed income, and you should not move your substantial amount of money. You should not act in a knee-jerk way. So the way to deal with it is you should have 5 to 10% into fixed income funds. That should be liquid. That will be used for changing your allocation or rebalancing your asset allocation. And that is something which you should not worry about the tax implication, because what you are doing is you are an opportunistic investor. You are trying to benefit from a wild movement in the market. You are trying to rebalance and ensure discipline. You must have fixed income funds as well without worrying about the tax implication.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.